that's not it. All right, let's get started. So a little bit about me. Some of you guys already know me pretty well. Some of you guys don't. I'm in management consulting with a Fortune 500 company called Accenture. Great company. I've been there for about a year now. So woo. And also do real estate on the side with Keller Williams. And I have an MBA in entrepreneurship and some other stuff in homeland security, and almost done with my master's in finance, hopefully soon. And some stuff about me before that, what I used to do, special operations medicine, paramedic. Some of my interests, I like reading a lot. I read a ton of books, writing and stuff. I have 2 kids and I have a dog. Okay, so this is not financial advice. I'm not an registered investment advisor, broker, anything like that. And I can't tell you, what to buy exactly what to do with your assets, but I can tell you what I do, and I can kind of give you a good feel of the right direction to go. So keep in mind, as many people found out in the past 3-4 months, that there is an inherent risk in purchasing, what are called securities or stocks or investments. They might go up and down in value, and depending on when you need it, you might lose out on some money. But there's also the potential to make money. So all this stuff, there's always risk, but without risk, there's no reward. So that's why we do it. So what this is not, I'm not going to say, hey, go out and buy XYZ stock. I'm not going to tell you right now is the time to purchase. I'm not going to tell you a month from now is the time, or 6 months from now. And you really shouldn't be timing the market. I kind of do sometimes, and it's kind of worked out, but you got to be careful. And that's where the risk part comes in. But if you're just consistent in investing, you're going to come out on top over time. The decisions you will have to make are based on your own research and your assessments. And I will show you how to get started doing your research and assessing securities. So I like this quote because Robert Kiyosaki, he wrote Rich Dad Poor Dad, and that kind of changed my view in investing. And I think this is a pretty cool quote because you're going to have people that rake in $200,000-$300,000 a year, but if they can't manage their money, they're going to be just as broke as anyone else. Like we have doctors that make $200,000-$300,000 a year that are just saddled with debts, and they make so much money and they drive super nice cars, but if they don't know how to manage it and they don't make the money work for them, they're just going to be broke. So harness that money with a good budget, make it work for you, and make it work for your children and their children, right? All right. So why invest? I'm sure you guys have heard quite a bit about inflation since we started just printing out checks and sending them to everybody. And the more money we print, the less the buying power there is in money as time goes on. Now, printing out a bunch of money as a market grows is not a bad thing because there needs to be liquidity in the market. But over time, inflation is going to chip away at your earnings if it's held in cash. At 2% in 2019, that was the inflation rate. And inflation is generally the rise in prices when there's more velocity of the money moving through the market. When there's more supply of the money moving through the market, prices will increase generally. So the Bureau of Labor Statistics, BLS, they track this with what's called the CPI, or the Consumer Price Index, and they look at all these numbers and they determine how much the price moves up. So in a year, if you had $100,000 and you lost 2%, now you have only $98,000 buying power. So I went on this website on the BLS and have a calculator, and I saw that $100 in the year 2000 had the buying power of $152.91. So over those 20 years, you lost that much of buying power if you didn't invest. And people put their money in savings and they expect to get a return, and they really don't. The national average is 0.09%, which is not a lot. So not counting inflation, if you put that in savings, you'd have $90 in a year, which is not a lot. And the stock market, the S&P 500, which we'll go over, grows about 10% every year. So in a year, you could potentially have $10,000 on top of that 100K. So that's kind of the reason why you invest. And there's this thing called compound interest. I'm not going to go deep into it, but basically, when you get interest on these earnings, and after that first year, you're going to get 10%, not on the 100,000, but on 110,000. So after year 2, you're going to have 121,000. So you made $1,000 more. But then it starts to snowball because the number starts getting bigger. You take 10% of a bigger number than it was previously. So after 5 years, now you have $161,000. And then 10 years, $259,000. And that's with your money just sitting there getting 10%. So you don't just make $10,000 every year. You start making a lot more as that money starts snowballing with that 10%. So would you rather have the $100,000 or $259,000 in 10 years? So let's look at how that kind of works. Let's say you had $10,000, because not everyone has $100,000 to invest, but people can find $10,000. At least you guys can. So let's say that there's 2% inflation and you held it for 15 years. In the blue, the money held in savings is gonna go down by about 1.91% every year. And after 15 years, that $10,000 is $7,500. The money market, which actually can get you about 1.5% in a money market account, and they invest in really safe securities. And I'm gonna use the securities, it's kind of interchangeable with stocks and ETFs and all that stuff. Securities is kind of like what it's called, and that includes treasury bills, treasury bonds, and all that stuff, which are very safe because they're backed by the United States government, but they're very low interest gained. So they invest in that, but at least your money gets 1.5%. So you only lose 0.5% with inflation, we'll say, at 2%. So you'll still have some money left. So now let's say you invest it and you get 10% net. You start seeing this swooping upwards and $41,000. And now let's say you put in $200 a month every month for those 15 years. Those $10,000 just turned into $127,000. And that swooping upwards is what's called geometric growth as opposed to linear growth. So it starts going up, and it starts gaining momentum as there's more money, and this becomes huge. Give it 30, 40 years, and you're looking at least $1 million. So that's kind of how that works, and that's why you put money into your 401k and all that. So I did. Wait, okay. Okay, what? I think some people here are taking shots every time I say the S word, so I'm trying to limit that. Securities, okay. I'm not related to that person. Anyways, XYZ wants to raise funds. So what they do is they create this whole structure, this financial structure, and it goes to the Security and Exchange Commission, the SEC. It gets underwritten by investment bankers, and people from Morgan Stanley and all those big firms that you hear about. And they do what's called an IPO, an initial public offering, right here. So this is generally to raise funds. They want to raise funds because they want to reinvest, right? So they create a distribution of individual shares that you can pretty much buy once they release it for a certain price. And they get a bunch of money from that, and they use that to reinvest or to expand into other markets or create new product lines or create research and development opportunities and all that stuff. And when you buy that, you essentially have a small ownership of a portion of the company in the form of shares. So if you own 50% of all the shares or more, you technically own half or the majority of the company, but they won't let you do that. So what does this mean? You have voting rights. So the company will send you'll get in your email from whatever broker you use. It'll say, for example, I don't know, Microsoft is thinking about doing whatever. What do you think? Input your vote. It's electronic nowadays, and one share equals one vote. So you have a vested interest in the direction of the company because it makes you money, and you can actually sort of steer it. Another thing it provides are what are called dividends, which is a distribution of cash, stocks, or rights. And usually they pay this quarterly, sometimes biannually or yearly. And you'll just get straight up cash that comes to you, and you can choose to reinvest it to purchase more of the stock, or just people actually live off dividends when they have enough in there. And that's a source of income for them. Every quarter they get income. You have to pay taxes on that though. So residual claim, something to know about this. The cool thing about stocks is you can go, in a sense, be part of a business and own part of a business, but you're not signing, securing a credit line against your home to be, to buy into this business. If the business goes completely bankrupt, the corporation, you lose only the value of your stock. So you're not going to have a lawsuit that's going to try to take away, your house, your car, any of that. It's just your stock goes away. So the liability is low. But the other thing is that with common stockholders, with shareholders, you're the last in line if the corporation goes out of business. So the assets and the income and all that will go to creditors or the government, So you're probably just going to lose all your funds or lose that stock and the value of that stock. So that's another thing. So how are stocks valued? This isn't to scare you, but it's to show you that you don't like. I went to school for this, and I'm still finally learning how to actually learn the actual value of a stock. So the way I kind of think about this is when you go buy a stock, it's um, you're in a sense buying all the assets and all the future cash flows and the potential for future cash flows and all that. And right here on the left is what's called a discounted cash flow method, and it gives you what's called the intrinsic value. And you have to do all that to literally find out if the stock is worth what they say it is. And it never is, because there's so much other stuff that goes into it. Another method is technical analysis. When people look at the previous performance and try to develop patterns and say, okay, according to these little lines, it's most likely going to go up or down or whatever. But then, of course, Elon comes in and tweets Tesla stock price is too high, and Tesla drops from 850 to like 720 in like an hour. So what did this all matter anyway? So there's so many external factors, speculation, events. For example, one of the cruise lines, I forgot which one, today said they secured 18 months of cash flow funding, and the stock shot up 10%. So random events, like a coronavirus or something, could tank stocks or increase them. So a lot of the time, what you're doing is speculation when you buy these things. You don't really know what you can. I'm going to show you some methods to kind of look at it, but a lot of the time it's going to turn into speculation. That's why a lot of people, it's kind of hard to make money with stocks. But there's other ways, and I will show you that too. So when people come out and they say, the future cash flow thing, if there's going to be an influx of future cash flow, the stock will go up. For example, if a pharmaceutical company comes out and they say they have a contract from the government to produce a cure for cancer, you're going to bet that they're going to shoot up because they're going to make a bunch of money off of it. So how do we actually measure the performance of your investment? And this is actually really simple. It's called a return of investment. And this could be applied to many things, like how much am I going to spend to go to this college, and how much am I going to make potentially from this college? Is it worth it? Am I going to be at a negative return of investment? And the way we do this is you look at how much the security is valued currently, and you subtract the cost of the investment, and then you divide it by the cost of the investment. This gives you a percentage, kind of a return of investment. So 20%. Right now you have a stock, it's $120 is what it's worth. You bought it at 100. You divide that difference of $20 by 100, 20%. And that's a pretty good ROI. The same could be with negative, because stock doesn't always go up. It sometimes goes down. So you bought it 67, or hold on, current value 45. You bought it at 67. That's going to be a negative, whatever it is. You divide it by 67, negative 32.84%. So if this is a negative up top, then you're going to be having a negative return of investment, which you want to avoid. And this is also good for comparing different investments and looking for, which investments would perform better, which are better for your portfolio. Do you want something that's a higher ROI? Of course, but then that's going to have a higher risk, and we're going to get into that. And then dividend yield, because if you look over here, to make $1,000 a year, you put $32,000 in Johnson & Johnson, and that's how you get $1,000 a year, plus the growth of the stock. Same with IBM. $1,000 a year is what you want. It's going to cost you $16,000 to just pump out that cash. And there's the there's a formula. And I have almost forgot. I have some notes too, and I'll share it at the end, because you're all going to forget this probably. Some of you might not. But with the notes, it literally has a step-by-step, everything I'm showing you right now. And you can just grab this, and if you're about to buy a stock, you can reference back to what we're about to go over. So risk. So let's look at these four securities, right? Which one would you want ideally? Obviously, 35% return would be the best, because you want the highest amount of money, correct? But the thing with risk is that the higher the risk, the higher the reward is. And this isn't something like that is programmed into each stock or investment or security. It's kind of what the market calls for. Um, so we look at risk over here. So low cash bonds. Bonds are debts that are taken by corporations to raise funds, and they will always pay unless the corporation goes bankrupt. So low risk, lower risk. Cash doesn't go away unless you print a bunch of stimulus checks and trillions of dollars. Who knows? Mutual index funds. This is a combination of multiple stocks, and there's more diversification, so it's lower risk. And large cap stocks, big companies around the middle. Real estate is a little more risk because you're taking on debt for this, and if they stop paying, there's a bigger issue than the stock just dropping in value. And then they invented some crazy, financial, some more types of trading, futures and options, which we're not going to get into because that's more advanced. And you can always win the lotto. You just have to get struck by lightning twice. So super high risk. Your money's pretty much going to go away. But if you do win, that's a lot of money. And it's a huge ROI. $2, $1 million. You can do the math on that. So you guys said 35%, obviously, but now let's look at the volatility. If you put your money in there, you might get 80%, or half of your money might go away. High risk, 25%, you might hit 55%, or you might lose 5%. That's actually not that bad, Or what about an almost guaranteed 9 to 15%? That's pretty good too. Or a guaranteed 3%. And this all depends on many things. Your risk tolerance, one. When do you need the money? Do you need it in 10 years? Yeah, sure. Throw it in this super high volatility one. Whatever. I can recover from a huge loss in the first 5 years. Do I need it in 1 year? I need that 3% guaranteed because I can't meet my objective if all of a sudden my money goes away by 50%. And people kind of change the allocations. Bonds are low risk. So they'll put more into bonds as they get closer to when they need it. We're here with the less time. So you see less is in stocks, more is in bonds, and some in cash. These are all just examples and kind of things you have to figure out on your own based on your risk tolerance, when you need the money, all that stuff. So let's look at some measures of performance. So when you look at the stocks, you can go on Yahoo Finance. Yahoo.finance is great. And you're not an analyst, but many analysts like to go on there and give you their ratings. So right here is Accenture. Lots of buys. And I did buy a lot of this, and it's worked out pretty well. And this gives you performance over time. So you can look at that and say, okay, if it has a good 5-year or 10-year performance, maybe I should hold on to this for a while because it seems to perform. And then you can look at news. Okay, that's a pretty big contract, 96 million. Well, it's pretty decent, I guess. So that's a huge potential cash inflow in the future. So stocks might go up because it's going to have more revenue. The company's going to be worth more. So stocks might go up because of that. And you want to look at the news stuff. And this is all in Yahoo Finance. And you can look at the performance charts. So we see everything was good. And that kind of happened to everybody. And we're kind of getting our way back up there. Okay? This is always interesting to see because not every company is going to respond the same way. If we look at Amazon or something, they didn't crash all the way down here. And Johnson & Johnson, they're already back to their pre-COVID crash levels. So you can see what kind of firms react during certain types of events, like this last event that happened. This is on its way back. Some are already there. Some are just flatlined still. So this is the S&P 500. And the S&P 500 is 500 of the largest cap companies in the U.S. And that means pretty much the biggest companies in the U.S. And we're going to go over that in a little bit. And this shows the general trend of the whole market in the U.S. So measures the performance, the whole market, the whole U.S. market, 2008, lost a lot, but generally in the green. 2018 lost a lot. This, I don't know. We'll find out soon, won't we? All right. Another thing you kind of want to look at, and you can find this in Yahoo Finance, or just Google price PE ratio for whatever company. When you look at different investments, you want to compare them against other similar companies or investments or benchmarks, industry benchmarks. All right, and we're not going to go into this calculation because I'm not going to be pulling up market values and all that stuff and earnings, but you can easily Google PE ratio, and that's a pretty common thing that they use when they compare similar shares or stocks. All right, let's get into how to actually trade the stocks. Okay, so you can't trade stocks unless you have a special account at midnight, or 3 in the morning. New York Stock Exchange Eastern Time, 9:30 to 4 p.m. Us in Chicago, 8:30 to 3 p.m. So have your last trade in by 3 p.m. or you're not going to be able to do it. And you're going to be wondering why. So, I move this. When you look at a stock or security, there's a few different components to it. Here is the ticker symbol, Tesla, TSLA. And every company has their own ticker symbol. Microsoft, MSFT, Accenture, ACN. And it's going to have a price. And this is market driven. And right here is going to have your gain or loss during the day. So this was a pretty volatile day. A 10% gain, I mean, that's pretty big. So this is what you look at when you start looking at the price of the stocks. And this is on Yahoo Finance. Yahoo Finance is a great resource to use for this. Okay, now, if you're on Vanguard, this is the Vanguard application. And on here, up top, the ticker symbol for Boeing. And they're going to give you 2 prices. And this is kind of important, okay? This is the bid and the ask. So when you go to sell this, you're going to get the bid price because this is what the dealer will pay you. But when you go to buy it, you're going to get the ask price. And if you notice, it's 6 cents higher to buy. So if you buy and sell immediately, which it's not going to be the exact same price because it fluctuates every second. But for example, if you were to buy and sell immediately, you would take a 6 cent loss per share. And you might say, and that's what's called a bid-ask spread. And you might say, that's not a lot, 6 cents. But look over here. You were paying $192, and you can only resell back at $73. That's a pretty substantial difference. And this doesn't happen often. Last time I saw this happening was when the market was dropping like crazy in March, and liquidity issues will cause this. But you want to know, and you want to look at it, and you want to make sure that there's no huge gap, and you're not taking an immediate loss in a sense. For the Vanguard platform, everything's a little bit delayed, 20 minutes. So it's not for like day trading. Vanguard's for investing long term. And then if you look at the day range, you can kind of see the volatility of the stock. And then the 52-week range, here's a huge volatility. That's because it was at 391 before it dropped down to 89 in March. And you're going to notice with a lot of stocks this year that there's going to be a huge volatility because everything just dropped in March in a crazy manner. So a lot of people use Robinhood. I wouldn't say this is good for long-term investing, but if you want to get in and start playing around, don't put all your money in here. It's not bad. It's really user-friendly. So this is for Carnival Cruise Lines. And they'll show you the market price, but you have to click into here to see the bid-ask spread. So they kind of hide it, which I don't really like. Like Vanguard more shows you everything. And obviously you put in the shares, and then multiplied by the market price will give you the cost. So, 2 of these will be around $30. Oh, and if you guys want to start like playing around in Robinhood, use this link right here. Join robinhood.com/HenryV418, and you will get a free share, and I will get a free share. So up to like $150, I believe. So use that link, get your free share. You get a free share anyway, but you know, it'd be nice to give me a free share too. So, but I wouldn't use Robinhood to like plan out your retirement, you know, type funds or like throw in your life savings or anything like that, to be honest with you. Go with Vanguard if you're going to do that. So these are some types of orders. When you actually place an order, you have flexibility in, oh, hi, Jackie, I just saw that. Hi, Jackie. You have flexibility in saying when you want the order to happen. So market, that happens immediately at the best available price. And I wouldn't really recommend that because it fluctuates and you might get something that you didn't want. All right. Limit's good because you set the price that it's going to execute at. So you have control and it executes at that price or below, but not above. So you get that price or below and nothing more. Market, you might overpay than what you think you were going to get. So, and then they have stops and stop limits. You can look at the notes for that. And you can also set how long the order is good for. So day, that means that during the trading day, the order is good. If that price hits the limit, then it executes. If it never hits it, and then it's discarded. You can also set it for 60 days, and that'll keep that open for that amount of time, and then discard it. GTC is good till canceled. You can cancel it prior. So if at any time during those 60 days that price drops to the amount that you want to buy it at, it'll execute it. So I would say use limits because you can be precise with what you want to buy. So limit buy is the way to do it, because you can be like, okay, I want to buy this at 140. Right now it's saying 140, but if I hit market, I might buy it at 145 by accident. So always good to set a limit price so you get the exact amount that you want to buy it at. Oh, we had quite a few people join. Hello, Melanie and Jennifer. Cool. All right. When you're going to sell, similar manner. If you want to sell immediately, you hit market, and that'll sell it at the best available price. Limit, you want to sell at or above a certain price because obviously you want to get, you know, the highest price possible for the stock or security. So always good to use these two, and you will be provided with these options over here. And let's say you have multiple purchases of Coca-Cola stock or something, or Pepsi. Yeah, multiple purchases of that. And you bought one in January, you bought one in March, you bought one in May. So these all have different what's called cost bases, what you paid initially. And if you select first in, first out, it'll kind of work under the assumption that the earliest stock that you bought of the same stock is going to be at the lowest price. It's going to sell that one, lowest price that you bought initially. So highest gain from now, that's the assumption. So that's how that works. But if you want to have even greater control, you can choose exactly which ones to sell. And that's with like tax strategy and stuff. So, all right, gains and losses. So what happens when you buy a stock and it fluctuates in price? We'll use examples for this. So you buy XYZ on January 15th and you pay $100. $100, pretty easy to use for this example. 10 days later, it rises up to $139. So if you do the whole ROI calculation, that's a 39% gain, right? But you don't do anything. It just rose up to that amount. You're like, oh, this is nice. You know, like I had a 39% gain, right? Nothing happens because you don't do anything. So on February 15th, it goes down to 133. And then you're like, you know what? I want to sell this and I want to capture $33 for every share that I had for the 33% gain. So you sell it within a month, pretty much, and the way you get taxed is as regular income tax. So this is regular income. So when you do your taxes, you get a form from the brokerage and you turn it in, and this is going to be taxed as regular income on top of your, you know, whatever your marginal tax rate is. Let's say that you waited 1 year oh, this should be 2021. All right, 2021, 1/16/2021, and it was the exact same price as it was when you sold it then, but you sold it 1 year later. That 33% is now taxed at what's called capital gains tax, and this is different than income tax. It's actually less for many people, and we'll go into that. So that's kind of how you're taxed. Regular income tax, if it's within a year and below; capital gains tax, if it's within a year and above it. And the government does all these incentives with taxes, and one of their big incentives is to get them to hold on to it instead of just constantly trading. They want people to invest in their future, so they tax you less if you hold it for longer. And keep in mind, this is only realized if you sell it. Now, losses. So you purchase the same stock, and March 5th, it went down 35%. No event if you don't do anything. It can go down to $1 per share. $1 per share. And if you just don't sell it, then I think that might be off. If you don't sell it, it doesn't matter. You can just wait till it goes back up. The stock doesn't go away unless the company goes bankrupt. Okay? So a realized loss is, let's say on the 5th April, it goes down 45%, and you actually sell it, that's when you realize a loss. So $45 per share, they can be written off in taxes up to a maximum of $3,000 per year. I think the math is off, and I was using the $100 as the initial example or something. So you can write off $45 per share up to a maximum of $3,000 per year. So now it becomes a tax deduction up to $3,000 per year when you take a loss. And again, if you don't sell it, you don't realize a loss. You can just wait for it to go back up to $1,000 a share. And if you don't sell it, you don't realize the gain. So like I was saying, if you sell it within a year, you have to pay ordinary income tax. If you sell it over a year, you have to pay capital gains tax. So I'm willing to bet most of you guys in here, not for long, will be probably around here, 15%. So this is kind of what the difference looks like. If you sold it at $39 per share, let's say you made $3,900 and your marginal tax rate was 32%, this is what you pay in taxes. Let's say you wait a year and you sell it for less. This is what you pay in taxes. So you actually make more if you wait a year because it only took 15% instead of 32. So there's some advantages to waiting over a year before you start selling off your securities, in tax advantages to the end. Okay. So people got pretty savvy. Oh, thanks, Melanie. Another one of my coworkers. She's awesome too. So let's say that, okay. Remember how I was telling you people were getting very savvy and making all these crazy like financial structures with futures and options? They did the same thing with the mutual fund. So basically what they did is they took all these stocks and they put them all into a fund and they create it into a share. So now when you buy a share of the fund, you indirectly buy all of these stocks. And it could be 10 stocks, it could be 500 stocks, it could be 1,000 stocks. And the way this is like much better if you're holding long term is the diversification reduces the risk. You're going to get the benefit from all these other stocks, but you're going to have a lot less risk. Because if, for example, Facebook and Google, if they go bankrupt, a lot of people have a lot of money, a lot of Google stocks, right? And if they go bankrupt, they'll just lose all that money. But if Facebook and Google go bankrupt and disappear from this fund, you still have all these other stocks to keep the performance going. So you're not going to just lose all your money or take a 25% hit. You know what I mean? It's going to, it might dip a little bit, whatever, depending on the size of the firm that went bankrupt, but it's going to hold strong over time. So the thing with these mutual funds is they may have some sort of goal. They may replicate a portion of the market, whether it be, I don't know, semiconductors or oil or the whole market, like the S&P 500. 500 of the largest companies are held in the S&P 500, You buy that share, and now you have a stake in the United States stock market in a sense. And the whole market's not going to fail unless we stay shut down for like 6 more months. Anyways, the thing about mutual funds is that they're slower to trade. The funds are processed after the market closes. I wouldn't say go to actively managed funds means that they have some like high earning, what are called CFAs, chartered financial analysts, and they're just sitting there like running all these calculations and picking stocks and moving them out and doing all that stuff. And they actually don't tend to perform. In the financial industry, there's a whole racket. Like it's crazy. You have to really be careful out there with financial advisors, with things like mutual funds, because they will do some crazy stuff that is, not. It's very low integrity. For example, they will put together 5 mutual funds or 10 mutual funds, and they will write 10 different like articles on them for a few different years, and 9 out of 10 will fail. And that one that they just got lucky, they will mark it and say, for 3 years, we said this was going to go up. And they do that all the time. So that's why you want to look at the track history. Don't buy a brand new mutual fund or, ETF, which we'll go into. You want to look at something that has a strong track record. And then fees. Fees are another thing that are going to eat away. Actively managed funds have higher operating expenses. So you could be losing 2% every year just from operating expenses. Front end, that's kind of like a commission when you buy the fund. It might be 5 to 8%. And then when you go to sell it, it might be another 6% that they take off, which is crazy because you don't have to pay that anymore. If you go on Vanguard, you can find tons of funds that don't have these fees. You shouldn't be paying these crazy front and back end fees. And a lot of financial advisors will charge you these fees. So you have to make sure you ask them if you're using one. 12B1, these are marketing fees, and they try to charge you for these fees to market their products. So you want to look at what's called the prospectus, or just ask, like, what are the fees? Like an operating expense fee? Yes, that's is it 5%? 0.5% is about the amount, is about what you can still get a good fund for through Vanguard. And a lot of mutual funds have minimum buy-in for like Admiral funds or something, and the expenses will be a little bit lower if you get like a buy-in at $10,000 for certain funds. But some might be $3,000, some might be $10,000, the same S&P fund, but the $10,000 one has lower fees. So you might want to go with that. So yeah, that's kind of how mutual funds work. ETFs, they're kind of like mutual funds, except they can be traded on the market just like stocks. Just like the bid-ask spread, they can trade quickly because they're executed just like you're buying a stock. It can be, traded at market price. Bam, you just bought it or sold it. It's a little bit cheaper. You're not doing all those annual fees, and because it doesn't wait till the end of the day to like process like a mutual fund, it reflects the market faster. ETFs are fine too if you want to buy those to include in your portfolio. And then indexes. So everyone's has their eyes glued on the Dow Jones Industrial Average, watching it swing up and down thousands of points, freaking out. And you're probably wondering, what does that even mean, right? So people throw together, all these companies that reflect, I guess, a portion of the market. The Dow Jones Industrial Average doesn't really reflect the whole market since it's only 30 companies. So the S&P 500 might be something that's more reflective of the US markets. The NASDAQ, that's for technology. So and that's an index too that people look at. So I'm not going to go into the mathematics between building an index, but basically it's something that tracks a certain portion of the market, and it can also be used as a measure of the health of the market. So the S&P 500 is important to know because 500 of the largest cap companies in the U.S. So highest value of outstanding shares. So that's the share price times the shares outstanding. However many shares they have in circulation times the price. So the most like expensive companies. Apple, Microsoft, Google, Accenture's on there. And if a company starts going low in value, they might be at rank 499 and they drop to 501. Now technically they're at the out of the S&P 500, and the company ranking at 501 might go up to 500, and now they're in the S&P 500. So they fall in and out, and the reason that the expense ratio for these funds is so cheap, it's because you don't have to have these people making 300K a year just picking and choosing stocks all day, and they just track the market. Buying the S&P 500 is buying a stake in the United States, market. So the market is difficult to beat. If you get anything out of this, I would say index funds and ETFs are very good. And I believe Warren Buffett, he bets some hedge fund managers that they couldn't beat his investment strategy over the long term, and he just put his stuff in the S&P 500 and beat them all. And that's a pretty known thing. If you're gonna put your money in anything, just put it in the S&P 500, and over time you'll be fine. So S&P 500 tickers are VOO. So if you go on, or SPY, if you go on Robinhood or Vanguard or whatever, you can actually just type that in and buy those. VFIX, that's more of a mutual fund through Vanguard, but it's still the S&P 500. So what makes it up? These are the sectors, and these start to vary as well depending on kind of where the market goes. I think healthcare recently became bigger, and technology is huge. A tech fund would be good too, a technology index fund or a mutual fund like VGT, Vanguard Technology. That's what I put my money in, and those will give you higher returns than just the S&P 500. This is as of, I think, yesterday or today. So year to date, we are negative 10.56%, but it did take like a 30% dip or something like that. A huge dip in March. So it's getting back there. But 3 years, 8%, but that's being brought down by what happened recently. And it's going to recover. It should go back up. And this generally is about 10% average year over year. And you can look at the trailing returns. So by month, 10-year, 11.59%. So if you want to get that, you can. S&P 500 is a very, very safe bet. So what's in there? Microsoft, Apple, Amazon. There you go. So these are the top 10 holdings in case anyone was interested in what makes up the S&P. So at the end of this, I don't want to discourage people from trading individual stocks, but they can be very confusing. And you might not have the ability to adequately pick and choose stocks except for straight up speculation. So investing in index funds over time might be a better route if you plan on making yourself wealthy and not going and getting penny stocks as a get rich quick scheme where all your money just goes away over and over and over again. Like I was saying, you can shift your portfolios. Initially, we're all pretty young in here, 20, 30 years old. You can be pretty aggressive depending on when you need the money. Remember, everything's on a timeline. And so you can allocate your stuff into stocks, which also means ETFs and mutual funds. And this is what Dave Ramsey recommends. I don't agree with everything he says, but this isn't a bad I guess model. So of that blue, you make that blue 80% now is represented by 100% of this, and you put your money equally every month into these four sectors, and over time you will have decent growth. So how do you get started? I use Vanguard. I have a Robinhood account. I don't really mess with Robinhood too much. I'm in it for the long term. I'm not trying to flip some stocks real quick because I don't have the time to do it correctly, and you have to be watching that like a hawk. Vanguard is great. Charles Schwab is fine. Schwab is fine too. Whatever. I like Vanguard. I've been using them forever. The customer service is great. And they have all types of products through there. Robinhood, if you're going to join this, like I was saying, if you weren't out here earlier, you get a free stock, and I get a free stock if you use this. I'm going to put that into the chat. And then I have a Facebook page where I put up information, write some articles on like current economic things going on in the world, and analysis. And of course, if you have any questions, my email is over here, and you can always contact me and ask me whatever. And I think that's it. So, great. Any questions? Oh, VU is VU and E. Okay, hold on.
Hey, you answered that already, Henry.
Okay, cool.
Hey, but I got a question for you anyways.
Yep.
Could you go back to the section you were talking about P&E, price earnings or performance, price earnings ratios, and re-explain that again? I didn't quite catch that.
All right. Ratio of that. It's kind of confusing, but it's just something that you can use to benchmark and compare against.
So in your example, Henry, when you have like the different industries there,
Yeah.
So a higher PE is a good indicator?
For long term, yes. Lower PEs will actually have higher gains for short term, and but it'll also have higher risk. But if it has a high PE for long term, it generally tends to show lower volatility and just like more prolonged, like more stable growth. And that's kind of like how the trends generally go with that.
And then with that, what's like an example of a lower PE value versus a high PE value?
Is it Boeing? No, not Boeing. There's some companies right now that, and then after this, that their revenue, they're not going to have any earnings for this year. It's going to be so low that the PE might actually be in the negative. So you might look at that and say, okay, do I want that long term? Probably not, but is it going to have high growth? Maybe. Can it hold on? So it's not necessarily a positive number all the time. It might be a negative number too. So it can't really say like, 5 is a low number, 10 is a low number. But if everything else is like 10, 9, 10, and then you have a negative 8, then you might say, okay, well, clearly they're not earning. But I mean, Tesla's freaking P can be weird too because they're super high, overvalued. So a lot of things can kind of skew the PE. Because the market value per share is taken into consideration, not just
So
the earnings.
so far I got like PE is like an indicator of risk in a sense because you said low PE means you're
No,
high risk.
not really risk.
Okay.
If you want to think about risk and the volatility, you look at previous returns, and statistics, standard deviation. You can look at the standard deviation of the previous returns, and that's more of an indicator of risk. I got some text ones. Is it possible to share? Yes, I will share the slides and give you everything. In my opinion, is there a minimum amount of money that would be worthwhile to invest in the S&P 500? There's really no like actual minimum of money, I would say. And it depends on so many different people and so many different things. But 15%, and this all starts when you're debt free, right? Like, I'm not going to give like investing advice, but if you have debt that's, credit card debt that's taking away 20%, it's gaining interest at 20%, and that's money that you have to pay. There's no point in investing in the S&P 500 when on average it's going to get 10%. So once you pay off debt, then you can start looking at investing in the S&P 500 or other funds, and you can, you know, when you do your retirement fund, that a lot of that is actually the S&P 500, which you can uh, make as part of your retirement, your 401k and all that. And then after that, you can take 15%. That's what Dave Ramsey says, 15% of your earnings and start investing it. But that's after you're debt free. You have a fully funded retirement account, if matched to the match, and then you can start putting 15% into that. I mean, I put as much as I can. Like um, I don't want to hold cash. I have my emergency fund, so everything that I'm not spending to like live, I'm just throwing it in there, whatever. Besides the emergency fund. Okay, I believe you mentioned that you put your money into. Okay, so it doesn't have a better ROI. SPY, VOO, and VFIX should have the same ROI because it's just S&P 500. They all are the S&P 500, so they represent it perfectly fine. They're just used by different vendors, I guess. Like Vanguard holds VOO and VFIX. They create the fund and they run it and manage it. SPY is, I think it's Schwab, I want to say, but it's just a different financial institution managing the fund. So the share price might be different. Like it might be $150 a share instead of $250 a share, but the return should be about the same. Yes, I buy into VFIX for S&P 500 and VGT for my tech. Yes. Any other questions? All right, guys. Well, that's an hour. Thank you so much. I appreciate everyone listening to this. And if you have any questions, just shoot me an email. I'll help you guys out.